Hi guys, how are things? In this video we're going to have a discussion around the difference between a self-employment situation and a limited company situation. Something they get asked all the time. I think this is something accountants get asked all the time as well. In theory, it's all going to come down to tax and how much money you are actually turning over or how much money you are leaving in the company situation. Let's look at a couple of examples here on these white sheets. Let's say you're a self-employed individual, just take the example of a plumber, and you're turning over, so sales in a year are €100,000, but you're draining down €100,000 during the year from costs and also from your own income. So what I mean by that is, let's say for argument's sake, just to keep the figure simple, you have €50,000 in relation to goods or services or whatever you're bringing into your business, and then you also have a $50,000 salary for yourself. Okay, so very rough figures. At the end of the year, there's nothing, okay? You turned over 100K, 50K has gone out in relation to expenses or costs of the company, and you've taken 50K out in a salary. Your tax in this situation is calculated on the 31st of October every year, okay? And the year is for the preceding year. So 2022, for argument's sake, you'll be making a tax return for 2021. Okay, so for those that are currently self-employed and you're working away in the background, you're going to have a tax liability for 2021 in October 2022. That's what it looks like to be self-employed. Now, when do you go towards a limited company structure, and why you should go towards a limited company structure are probably more important. And that's to probably build up more wealth in your name, as in the company director or shareholder's name. So what do I mean by this? A lot of people would say you need to be earning over maybe 100, turning over maybe 150,000 before you go to a limited company. And that's because there's a lot of costs associated with running the majority of businesses out there. And a limited company structure should really only be used when you want to retain your earnings in your company or in your business. So let's go look at an example again. Let's say the limited company structure here, you're turning over €200,000. Okay? So a nice healthy year. And again, let's say the situation is same here, that you have costs of €50,000, costs or expenses of €50,000, and you're taking a salary of €50,000. In this situation, you have €100,000 left over on an annual basis. Now, if this €100,000 or this €200,000 was the same for self-employed, you would automatically have to pay the tax on that €100,000 in the October the following year. And that tax is most likely going to be up around 50% or more. However, in here, you get to keep that money in your limited company structure. And generally speaking, depending on what you're doing, it's 12.5% corporation tax. But that means you get to leave a bigger chunk of money in the company. So compared to 50% over here, it's only 12.5%. Now, the other good things about limited company structure is that you can build that wealth up in the business, and you can take it out in a number of different ways. The first I'm going to speak to you is called entrepreneur relief. That means if you sell or liquidate the business, you're going to be able to take out the first €1,000,000 and only pay 10% tax. Now, usually speaking, you'd have to pay 33% capital gains tax. So that means for €1,000,000, you're only planning to pay 100,000 or 10% in tax and take 900,000 off the table. The other thing you can do in the limited company is you can also look at what's called retirement relief. Retirement relief is there from 55 years of age, few rules around it, but in theory, you can take up to 750,000 tax-free out of that company structure. In both instances, you can also put money into a pension plan, but generally speaking, you can put more into your pension plan through the limited company structure than you can from being self-employed. So if anybody asks me which one would I prefer, I'd always say a limited company, but it really is only that case if you have these returned earnings in here. Okay, so this figure, it's €100,000, it's a big enough figure, but imagine if it was 200,000 or 300,000. Rather than writing a check to the revenue commissioner for up to or maybe more than 50% like in a self-employed, you get to write a smaller check over here and retain the money in your business. Now, the money that's retained in your business allows you to maybe expand your business, allows you to bring in more staff, and by doing that, you're hoping to make more profit. So that's why I will always say, if you're starting off in year 1 or year 2, limited company is probably perfect, but as soon as you start making decent income or decent returned earnings, you want to keep it in here. Now, obviously, you can take this money out and top up your salary, but you're going to drain your company completely, have no cash in it, and you're back to nearly the same situation and paying over 51% to the revenue commissioners. Again, as always, I hope this makes sense. Any questions at all, please comment below, send us a DM or send us an email to questions@askpaul. Please like, share, and tag somebody in this video that you think needs to see it. Have a good day.